see my screen? Anyone?
Hey, great here. Yeah, I can see.
All right, perfect. So let's get started. This is going to be a general introduction to Nimoy to start, and then we'll go over the GameStop setup, the AMC play that we tried and failed, and we'll go over the meme page, and we'll also go over the mangum page. So to start, we'll use Apple as an example. So this is the day trader chart. There are, I'm just going to close these tabs so that things run faster. So there are basically 6 things to look out for in a Nimoy. So we have the hourly trigger, which is, the purple line. And this tells us like in between micro and macro trend. And then we have the 5-minute trigger, which is, still pretty important, but not as important as the hourly trigger. And we have the 1-minute trigger. Now for swing trades, the hourly trigger is most important. In short, it's basically buy above the hourly trigger and sell below the hourly trigger. That part's fairly straightforward and fairly simple. And if trading just like that, you're bound to make some significant profits. If you want to cut out all the other noise, let's just take a look right here. So this is the 2-week chart for Apple. So you could have went short right here at 158 and bought back at 152. Then you could have went long at 152 on this break above the hourly trigger, and you could have sold at 153.7 on this break below. And then over here, you could have rode this short, from 152, 153-ish, all the way to the price of 140 where it is now. Now, these two, this is a rejection, popped back above, but came back down. This is also a fake out. This wasn't the overnight. Okay, so let's look at the hourly below. Okay, yeah, so I'll zoom in here so you guys could see. But you see how when price popped above here, there was no significant hourly velocity prints to the upside. So here's how this works. The difference between a regular EMA or an M or a MA, like a moving average or an exponential moving average, like why is the hourly trigger different than an exponential moving average and a moving average? Like kind of looks like the same thing. So the difference between the hourly trigger, here, let's see if Netflix is a good example. The hourly trigger and the EMA is that with the hourly trigger, you also have hourly velocity. And hourly velocity is a very powerful tool because if you're watching a regular graph and price is nearing an EMA, technically you have no idea if price is going to break through the EMA or not. Will price reject? Will the EMA act as resistance? Will the EMA act as support? With hourly velocity tells you 100% sure, like without a question of a doubt, if the hourly trigger is going to hold as either support or resistance or not. So, you can see here, price came up to attack the hourly trigger with negative velocity of -5 for Netflix. For any mangum, actually, for any stock trading in the 200 range, that is a significant number. For GME, the number is much lower. It's 0.1, but we'll get to that later. So you can see this negative velocity print. Price tries to attack the hourly trigger. Using a Nimoy, here are the rules, right? It's very simple. When price is coming to attack the hourly trigger, what does the negative velocity look like? The negative velocity is -0.51, which is -50 cents. Now, knowing the rules of a Nimoy, you know that the hourly trigger right here is going to provide resistance without a shred of a doubt, 93% of the time back tested. So you can be waiting here, and as price comes to attack the hourly trigger, you can short. No doubt, no fear, because you know that the hourly trigger is going to provide resistance. And sure enough, price sold down from 230 to 224 and even came down to right here, probably 223-ish. And that's a monster short. It happened in the course, so 938, so not even in 20 minutes, price gets whacked off the hourly trigger and sells down in 20 minutes. That's a $6 move. Now, if we look later, you can see the price actually broke through the hourly trigger. But what happened here is that the negative velocity print was negative 2.7. Now, it's important to know what the velocity prints are for each kind of stock, for each kind of big cap, small cap, medium cap, but watching them close enough for a short amount of time will give you the info on that. Now, another thing to look for when price is coming to attack the hourly trigger, and here's where we'll move down to the lower time frames, we want to look at the 1 minute velocity and the 5 minute velocity. So here's the 1 minute trigger and the 5 minute trigger. Now they kind of act exactly the same as the hourly trigger in terms of velocity. So if you have, for example, strong 1 minute velocity, you're going to expect the 1 minute trigger to provide support. And if you have strong negative 1 minute velocity, you're going to expect, like, for example, right here, came down, we sold, we were coming off some pretty strong negative velocity, and price rejected the 1 minute trigger and sold back down, popped above when the negative 1 minute velocity was much less. So here it was strong, which provided a rejection. Here it was way weaker, and price was able to pop above. Same thing with the 5 minute velocity and with the 5 minute trigger. So, we had good, strong 5 minute velocity here, so the 5 minute trigger provided a bounce. But over here, the 5 minute velocity was much weaker, and price fell through the 5 minute trigger. Over here, we had strong 5 minute velocity to the downside, and so price rejected the 5 minute trigger. But over here, we had not so strong 5 minute velocity to the downside, and so price popped above. Now, if we look over here at this attack of the hourly trigger, you can see that as price was coming up, we had a really strong 1 minute velocity. The 1 minute velocity was a 0.5. And so as price is nearing the hourly trigger, you want to check the 1 minute velocity and the 5 minute velocity to know if price is going to break through the trigger or reject the trigger. Now, for example, you can see over here how we had such powerful 5 minute velocity right here, right? We're getting readings of 0.67 at the top, 0.7. So you can see that here, this is pretty important. When you have, and you can see the hourly velocity was very strong as well. All right, so the hourly velocity was 0.9, 0.8, 0.84. This is really strong hourly velocity. So another rule of the Nimoy is that when you have really strong hourly velocity, you're going to expect the 1 minute trigger to provide support. And we can see throughout this entire move, price, if you were even hiding with your stop loss below the 1 minute trigger, so let's say you bought right here, and we actually caught this long. We didn't go long in it because it was too expensive for the $100 challenge, but we saw this long. So we saw price break above the hourly trigger, and this was at like 2:30 or so. And then the hourly velocity print was 0.4 right off the bat. That's really strong. And then we get an hourly velocity print of 0.8, which is really strong. So now we're like, okay, since the hourly velocity is so strong, we can expect this 1 minute trigger to provide support. The stronger the hourly velocity is, the stronger the 1 minute trigger and the 5 minute trigger are going to provide support. And the stronger the hourly velocity is to the downside, the stronger the 1 minute trigger and the 5 minute trigger are going to provide resistance. So over here, this entire move, right, from 228 all the way till 245, the 1 minute trigger, price never even sold below the 1 minute trigger. And so if you were just using the 1 minute trigger as your stop loss, you could enter on a break above the hourly trigger, which is, pretty much the best way to make money on the Nimoy is to take a play when price breaks above the hourly trigger or breaks below the hourly trigger. Because the hourly trigger acts sort of an acceleration level. Whether price breaks to the upside or to the downside, you're going to expect price to accelerate in that direction once price breaks to the upside. Now, technically, you're going to want to see an hourly print first. So, you don't automatically enter right here because even if price breaks above the hourly trigger, until you get a really clean looking hourly velocity print, like here would be the first one, this would be your confirmation that, okay, price is moving bullishly right now because we have strong hourly velocity. But even without that, you could enter on any break above and then just keep your stop loss right below for minimum risk reward. So if you were entering right here on the break above, that was at, let's say, 224. So the hourly trigger is at 228. So price pops above. Let's say you buy at 229, and then you can keep your stop loss right below the hourly trigger at, at 228, 227.90 this entire move. That's if you're, let's say you're swinging. If you're trading options, you can keep your stop loss right under the 1 minute trigger. That's if you're playing, let's say, weeklies. And if you're playing, let's say, longer dated calls, let's say like 2 weeks out or 1 week out, you can just hide under the 5 minute trigger. So you can buy here, and the 5 minute trigger is going to act as your support, and then as soon as it breaks below here, you can sell at 243. So, this is an easy example of how to use the hourly trigger to buy on the break above. And then you look at the hourly velocity, it's really strong. When hourly velocity is like this, you can literally just step away for a few hours because it means that there's so much buying pressure going on in the stock right now that, price is gonna move higher until you see significant divergences on the 1 and the 5 minute. So you can see how the 5 minute velocity just slowly came all the way back down. And when it got to this really low point right here, that's when price sold through the 5 minute trigger. And if we could do the same thing with the 1 minute trigger, you can see right here we had really strong 1 minute velocity, and then 1 minute velocity got really low, and then price sold through. Now, I want to talk to you guys here about bullish divergence. So bullish divergence is when price makes a new low, but velocity doesn't. And the most important times to use that is when price is revisiting an important trigger, let's say the hourly trigger. So here price is coming down to the hourly trigger, and the hourly velocity has already dropped off significantly. And at this point, you're wondering to yourself, is the hourly trigger going to hold? Is it not going to hold? So normally you can look at all this hourly velocity, and you could say, I think someone's mic is turned on. All right. Normally you could look at all this powerful hourly velocity and say, okay, this hourly trigger is going to hold for support, and and as price comes down, if whoever's mic is on, if you could just mute yourself, we appreciate it. Thanks. So, as price comes down to the hourly trigger, you're gonna want to be buying off the trigger because we have good hourly velocity. But for some confirmation, you could zoom in on the lower time frames. So let's zoom into this period right here. Okay, so price comes down, and so price comes down here, or even here. Okay, price is at 239, and here we see our most extreme reading, our most extreme 1 minute velocity reading to the downside, which is negative 0.15. And then as price makes a new low over here at 236, well, you can notice bullish 1 minute divergence. So you can see that the 1 minute divergence, the strongest 1 minute print to the downside right here, a negative 1.5. And when price makes a new low, if you draw a trend line, it's pretty obvious if you just look at it. But the 1 minute velocity is not making new lows. And so as price is making new lows, oh man. Gio, I think, do you mind muting your mic? All right, appreciate it. Thanks. Okay, sorry about that, guys. So when price makes a new low, but your 1 minute velocity does not make a new low, that tells you that there are buyers at the hourly trigger. And that's very important because you want to know if this hourly trigger has significance to it. Is it going to provide support? So when you see the 1 minute velocity, the most extreme reading right here at negative 1.5, and then price makes a new low, and there's no way, this is very important, you guys should really try to understand this. There is no possible way for price to make a new low without velocity making a new low unless there are buyers stepping in. Okay, so from the fact that velocity did not make a new low right here, right, you can see it's a negative 1.3, and here was a negative 1.5. From the fact that velocity did not make a new low, automatically that tells you there are buyers waiting at this hourly trigger that are ready to push the stock up. And then you could see over here where we make this new low, 235.99, the 1 minute velocity is 0.05. So this tells you that from this time period right here, when price is at 239 and the negative velocity was negative 1.5, all the way to this time period, buyers have been stepping in big time. And when buyers are stepping in big time near the hourly trigger, that's your signal to go long. And if we look at the 5-minute velocity, all right, we can see the same thing. So we make a low right here, and the negative 5-minute velocity is -2.6. And then, we come down, we touch that same low, price of 236. Look at the 5-minute velocity, right? If I remove everything else is pretty obvious. As price is coming down, all right, to this low and to this low, massive buyers are coming in, because if buyers were not coming in, it would be impossible for velocity to diverge like this. If buyers were not stepping in, then right here at this low of 235.99, you would see the most extreme 5-minute velocity print to the downside. So here was a negative 2.6 on the 5-minute velocity. If there weren't really strong buyers here, you would automatically see greater than negative 0.26 right here on this low. From the fact that there isn't, that tells you that strong buyers are coming in to push this stock up. So you can see it on the 5-minute velocity, you can see it on the 1-minute velocity, so it's very clear, and we're at the hourly trigger, okay? And we had really strong hourly velocity on this entire move. So that tells you I want to buy right here at 236, at 235. And then what happens? Price, comes up to 239.82. Even if you want to take this swing right here, right? So that's that. If anyone has any questions on any of that, you're more than welcome to step in and ask. Okay, so here, a perfect example of the hourly trigger doing what the hourly trigger does. So price sells down, we have negative hourly velocity. We have, really powerful negative hourly velocity, -3, -3.0, and then price comes to attack this hourly trigger right here. Now you can automatically sell this, and when you do sell this, you can keep a stop loss right above the hourly trigger. So in this example, the hourly trigger is at 140.41, right? And you see price coming to attack it. So when price gets even close to the hourly trigger, you could already start buying puts. And your stop loss here would, let's say, be 151.00, 50-cent stop loss, very tight risk reward, and you would have caught this entire move down, And then over here, once you see negative velocity like this is a really extreme reading to the downside. You're not looking to go bullish until you see something like this. Now, do you guys see what this is? Based on what I just said with the 1-minute and 5-minute divergences, the same rules apply to the hourly as well. So do you guys see how price came here, made a new low, but where was the most extreme hourly velocity reading to the downside? That was right here. So the most extreme hourly velocity reading to the downside was -512, and price was at 143, or the low was 142.4, okay? So it is impossible for price to make a new low without hourly velocity making a new low unless there are really strong buyers coming in. And what happens? Velocity does not make a new low here, although price does. So this is hourly bullish divergence. Same thing like we just said with the 1 and 5-minute. And what happens? Price turns around and rips up. Price makes a nice bounce and a nice recovery. So if you're watching this and you see this new low, as long as velocity doesn't make a new low, you can come in here and buy this dip. Now let's look at what it looked like on the 5-minute. And we'll bring the 1 and 5-minute triggers. Okay, and then even without velocity, another useful thing of the 1 and 5-minute triggers, you can just play really like crosses, okay? So whenever like the 1-minute trigger, which is the gold line, crosses above the 5-minute trigger, which is the blue line, and price is below the hourly trigger, you can pretty much expect price to go up to the hourly trigger. Whether it will reject or not, that we don't know. But, that's when the bot turns flat, because it doesn't want to be short anymore, because there's a great chance of running to the hourly trigger. But it doesn't want to be long either, because it's below the hourly trigger. When the gold line right here, so look at this cross, the gold line crosses below the blue line. When you're below the hourly trigger and the 1-minute trigger crosses below the 5-minute trigger, that's full bearish, and that's when the Nimoy bot goes short. The bot that I'm talking about is right here. It flips from flat, short, or long. And the reason why it's flat right now is because, as you guys can see, at the end of the day, the 1 minute trigger actually popped above the 5 minute trigger. You guys can see where my mouse is right here. So you can really also just trade trigger crosses even if you don't want to use velocity. Now I want to zoom in on something here. This is something called an airplane. I spoke about this a lot in the group, so it would help if you guys actually know what it is. So an airplane is when the 1 minute trigger comes down to the 5 minute trigger and then like bounces off it basically. And you can buy these 90% of the time and literally make money on the first scalp. So what happens, it's basically what the algorithm, this is all AI. So what the algorithm is telling you is that, you know, when these two meet and the 1 minute trigger comes back off, price is about to make a new high. So every time price is ever about to push to a new high after a period of consolidation, you will always have these kinds of airplanes. Now this one is a little deep. Most of the time you'll see, here, let's show, I have a good one on GME. This happened yesterday. All right, so can you guys see them? I'll remove price. So, okay, let's say we were not using the hourly trigger, we weren't using anything besides the 1 and the 5 minute trigger. So here on this trigger cross right here, so the 1 minute trigger crosses the 5 minute trigger, you can go long right here. Let's see what price was. Price was 24, okay. You can go long right here. Now what happens here? This is exactly what we call an airplane. The 1 minute trigger comes down to the 5 minute trigger, bounces off, that's an airplane. It means price wants to push to a new high. So still no reason to sell. Now a lot of the times when I use an Nimoy, I don't have the price on at all. I'm just watching the algorithms. What are the algorithms doing? Because if I would have the price on, maybe I would have got scared out here, right? But this is exactly what the algorithms do. They stop loss hunt before it moves to the upside. So you could have got stop loss hunted right here, because that's what, if an algo is ever about to take a stock to the upside, it's always going to try to hit stop losses below it first. So I like to a lot of times just watch, you know, the 1 minute trigger, the 5 minute trigger, the hourly trigger, they're all algos in the market. And Nimoy just reverse engineers them to show you exactly what they're doing. So, you know, still no reason to sell here. So we bought at 24.50, we're long, and then over here we get the same thing. The 1 minute trigger comes down, glances off the 5 minute trigger, and then lifts up off it again. So as soon as this action happens, right, so it gets pinned right here, as soon as the 1 minute trigger lifts off, that's your sign that price is about to make a new high. If the 1 minute trigger crosses down and you see it starting to separate from the 5 minute trigger, that's your sign to sell. You could get out like right under that. Now let's see if we were using price also. All right, so price also, you know, you could have got again. You could have got stopped out right here. And again, they always are going to take out lower stops before bringing it up again. That's why, for me at least, I like to just watch the 1 and the 5 minute triggers. Either way, again, over here, we have, again, this is called an airplane. These are so important to watch throughout the day. When you're in a stock that's just drifting sideways, you want to watch what the 1 and the 5 minute triggers are doing. If the 1 minute trigger crosses below the 5, that's your sign to get out. Because once that happens, for example, right here, the stock will sell off every single time. Once you get this trigger cross, it's not like maybe the stock will sell off. It's the algo's already decided that they're going to take the stock down. There's nothing really anyone can do about it, so why fight it? And Nimoy tells you what's going to happen. It's not like TA or something like that, where you know you're trying to figure out what's going to happen. And Nimoy tells you exactly what the algorithms of the market already decided for you. And you could either go with it or you could fight against it. So either way, here we have another airplane. Here, you know, it gets pretty close. This is still considered an airplane as the 1 minute trigger comes down to the 5 minute trigger. And over here is, you know, where you get the trigger cross and you'd sell. So let's say you were trading GME yesterday, you know, from September 26th, you would have bought at 25, and that's on September 29th. So 3 days later, you would have sold right here at 27. Now, let's see, again, let's just bring in price. All right, so, you know, you could have got stopped out here if you were just using price. You may have even got stopped out here if you were using price. But if you don't pay so much attention to price and you pay attention to triggers instead, you'll likely do a lot better. Now, let's look if there was any hints that this was the top and that we might be about to sell off. So let's look at the 5-minute velocity. All right, now this is a great example of 5-minute divergence. So the way 5-minute divergences work is you want to go by 3. So in order for, if you want to guess that a big sell-off is coming, technically you could do it after like 1 or 2 divergences, but you really want to wait for 3 new highs. And so if we look from when price broke above the hourly trigger right here, okay, so that's when technically it starts. That's when you can start counting. Then you look for the highest 5-minute velocity print, which was right here, 0.06. Nothing pretty crazy for GME, but 0.06 was the highest velocity print, and price was at 25 at the time, 25.66. And then when price makes this new high right here, you see how velocity doesn't? It's impossible for price to make a new high and velocity not to make a new high unless there are big sellers right here. It's impossible. And if there are big sellers, what's going to happen to price? It's going to get pushed down. And so if you're trading this thing and you're in right here at 25.66 and then price makes this new high, the first thing you want to check is 5-minute velocity. Did we make a new high? If we did, then buyers are stronger than sellers. If velocity did not make a new high, that means there's a bunch of sellers camping out here and I want to sell as well. And you could have missed this move down and could have bought back on this airplane if you're really trying to scalp. I'm just trying to explain how Nimoy works. Obviously, I don't trade like this. If when price breaks above the hourly trigger and we get this first hourly print, here's like nothing too special. I probably would have got stopped out right here, but then came in back above here. So this is a little unusual. This is the hourly trigger holding support, but a little loosely. Okay, so not every time it's going to be to the penny. Sometimes the hourly trigger will catch it like a trampoline. So when you jump on a trampoline, you don't spring right back up. The trampoline comes down a bit, and then you spring back up. So think of the hourly trigger as the same thing. It's not automatically to the penny, like this was to the penny, for example, but this was to the penny too. Sometimes it'll act more of like a trampoline. Either way, back to the divergence. So, here you have your divergence and you sell right back down. And then, price makes a second high right here. So here's the first high, then price makes a new high, velocity isn't higher than this one, and price sells back down. Price makes a new high here, velocity isn't high, price sells back down. Price makes a new high here, velocity isn't higher than here, price sells back down. So it's very choppy trading. Like, you were able to see right away that GME wasn't like super bullish. It wasn't like a rocket ship move. And we also knew that because we didn't have an hourly velocity print of 0.1. If you want to get a runaway move for GME, you're going to need an hourly velocity print of 0.1. And you can see how the hourly velocity print was 0.093. So 0.007 away from the magic number, which would have led to a melt-up move. But when you keep having divergences like this in the 5-minute, it's telling you, something's off. And then finally, when we make this last high, you can see how low the 5-minute velocity was. And if you draw a trend line from this high to this high to this high to this high, you can see that the 5-minute velocity rejected right off the trend line. So, always important to draw trend lines off velocity as well. For example, if you had a trend line drawn from here, connected to this high, connected to this high, when price made this new high, you could watch your trend line. If 5-minute velocity breaks above, you're probably going to have a runaway move to the upside. But if it rejects, and you have 1, 2, 3 divergences already, that's probably going to be the end of this move. And especially when you make a new high like this, and the 5-minute velocity is half of what it was here, or this is actually 0.29, 0.64, yeah, little less than half of it was here. It just means sellers are huge up here, and sellers are really camping out, and they're about to come out strong. So if you're making a new high and you want to confirm that the new high is bullish, you want to see the 5-minute velocity make a new high as well. Okay, now another good example, 5-minute velocity, bullish 5-minute velocity. So here you can see the most extreme reading to the downside. Let's remove the 1-minute trigger. So the most extreme 5-minute velocity reading to the downside is 0.08. at a price of 24.92. Now, you could see here, price made a new low of 24.74, but 5-minute velocity is 0.03, which is, you know, a lot less negative than it was at this low. Now, again, it is impossible for price to make a new low without velocity making a new low unless there are big buyers at the 5-minute level. And since there are big buyers at the 5-minute level, you can expect price to go and attack that 5-minute trigger. So we get this divergence right here. Price makes another low, so lower than here, right? This is 24.77. This is 24.88. If we're making a new low, right, 24.77, if we're making a new low from here, then 5-minute velocity, if it's bearish, would also make a new low, and it would be below, it would be more than negative 0.08. Due to the fact that it isn't, tells us, okay, buyers are strong, buyers like this stock at 24.77, and they're about to push it up, and that's exactly what happens. So this is more of a, you know, a day trading tutorial. You can apply all of these rules, literally all of these rules, to the 6-month chart as well. So I'm basically going to be wrapping up here, and then I'll take questions, but I'm just going to give you an example. So if we, you know, I just want to take this downswing for you guys and show you 3 hourly divergences that, you know, told us this pop was coming. So if we look at the hourly velocity, where's the most extreme reading? Right here at a price of 34.90. The most extreme reading is the hourly velocity print of negative 3.2. And then price makes a new low right here. You know, this is macro. So we count all this not as new low, new low, new low, new low, but once you get a low and consolidation and a little bit of a retracement, that's when we mark the low. So we get a new low here, but you can see big difference in the hourly velocity. So buyers are coming in, that's 1. Now remember, once you have 3 divergences on any time frame, price will automatically go back to that trigger. So if it's on the 1 minute, if you have 3 divergences on the 1 minute, price will run to the 1 minute trigger. If you have 3 divergences on the daily, price run to the daily trigger. So here's your first low, and then here's your second new low. And again, hourly velocity, not nearly as bad as it was here, so buyers are stepping in. And then you have your third low right here, and hourly velocity is less negative than it was here, and immediately price runs to attack the hourly trigger and pops above. Now you also have daily velocity, and you can see for GME, daily velocity, you know, we had some, can't really call this a divergence because it wasn't a new low, but you still get the idea, you know. When price was down here the first time, negative daily velocity was negative 6.5. When price was down here the second time, negative daily velocity was negative 3.2. And so price ran from 24 all the way, it actually ran higher, but Nimoy only marks hourly closes. I think we just saw it ran to like 29 or something, but it was short-lived. Let's look at the, okay, so this isn't the greatest thing to see. So Nimoy gives you the daily velocity print a day before, which is pretty nice. So we know going into tomorrow, this is the daily velocity print, negative 236. But then again, you know, you have weekly velocity. This isn't looking too pretty either. Something to keep in mind. And this, basically, real quick, this weekly velocity is telling us that even if price would run and attack this weekly trigger right here, it's automatically going to reject. Like automatically. Like you could see here, we had negative weekly velocity, price ran to the weekly trigger and rejected. And then rejected again here. You know, again, like a trampoline. Like it doesn't need to be to the cent, but it's going to reject. And that's what it did here. And then here, and it only was able to pop over when there was no more negative weekly velocity. So that's pretty important. You could see here an example of the weekly trigger providing support because there was positive weekly velocity. So positive weekly velocity, price attacks the weekly trigger, it's a buy automatically. And again, like a trampoline, price sinks into it and then springs right off it. It doesn't need to wick it to the penny and then bounce. Then you actually get really big moves off bounces off the weekly trigger. You also have really big sells once price breaks through. So look at this. And this is how the algorithms work. They're very sneaky like this. So if they're about to take a stock down, what they'll do is they'll take it down all the way at the end of the week. So them taking it down here at the end of the week, and velocity is calculated after close on Friday. And the weekly velocity is calculated then at close Friday. So they'll take it down right before the end of the week, and therefore the next week's velocity is only a 0.14. And with a 0.14, they're able to break the weekly trigger to the downside, and that's what starts this huge selling. You could also see here, when it broke the weekly trigger to the downside, we had a huge selling. However, the good news is that when we break the weekly trigger to the upside, hopefully we'll have another spike like this. Now it is Thursday, so if we could make a significant recovery tomorrow, we might be able to go into next week with weekly velocity, with much less weekly velocity, which will give us, like a 1 week here, and then the negative weekly velocity would be getting better and better as the weeks go by. And then there's also the monthly trigger and the monthly velocity, but you guys get the idea of how this works at this point. All right, so any questions?
Hey, so
this is what we call a 3 trigger cluster. It's when price is above the hourly trigger. All right, let's zoom in on this. Price is above the hourly trigger, and you have the 1 minute trigger, the 5 minute trigger, and price, and the hourly trigger and price all clustered together. Okay. Now remember how I told you, like, when the 1 minute trigger comes down to the 5 minute trigger and glances off it, that means that price is about to make another move higher. So when all of these are clustered together, and you could see 25.48, 25.52, 25.53, 25.54. So they're all within a 1% spread of each other. Okay? So when this happens, once price lifts above all 3 triggers and the 1 minute trigger lifts above the 5 minute trigger, you automatically expect a powerful move coming, more powerful than an airplane. So this is an airplane right here. When you have a 3 trigger cluster set up, you expect a really powerful move to the upside. When you have a 3 trigger cluster set up to the downside, let's look if Apple had one actually. That's when you expect some big selling to the downside. So let's just check right here. Here, perfect. So let's zoom in on this. So you see how all 3 triggers are clustered together right here. So let's see, 151.77, 151.60, and 151.49, all within 1% of each other, right? 3 trigger clusters work best when they're within 1% of each other. You can do 5% too, but for best results. Now, once price breaks through, once price breaks through the 1 minute trigger and the 1 minute trigger crosses the 5 minute trigger to the downside, that's when you can expect a really bearish move to start. And sometimes these will last for days. Because when you get a 3 trigger cluster, all the algorithms are sitting together and they're deciding, okay, which way are we about to take this stock on a trend? 3 trigger clusters set up trending moves. So once a 3 trigger cluster happens and price breaks to the upside or to the downside, you're locked in on that trend right now. So let's say it breaks to the downside. In your mind, you're thinking, I want to sell bounces, right? And I think the stock is going to keep driving lower. And you only get rid of that mentality when you see significant divergences. Like over here, we saw a significant hourly divergence. Maybe you could get rid of that mentality here. But throughout this whole move, you could have just been selling rips because 3 trigger clusters are really powerful. Especially here, we reject. The only way you'd close your short after a 3 trigger cluster is if price breaks above the hourly trigger to the upside. And even if it does, you're automatically in profit because you sold right here. 151.49. The hourly trigger here is at 150. So you can't really lose money. So once you have a 3 trigger cluster, you can go long or short. And then you want to close the trade when you see significant divergences that tells you, okay, the move is ending, or if price breaks the hourly trigger in the opposite direction of your trade. Let's see if we could find a couple of other good ones right here on some of these mangum stocks. Okay, nothing here. See, this is just price breaking above the hourly trigger on very low hourly velocity. Wasn't able to get anything really strong. Powerful hourly velocity, sold back down. This was really tricky, okay? I want to show you guys this. This is something that Nimoy doesn't really help with. Overnight gap downs, right? So normally, in this situation, I would 100% expect the hourly trigger to hold here. But if you guys look at the time, 16:00 at the bottom, that's 4 p.m. in New York, and then we opened up at 9:30 below the hourly trigger. So overnight gap downs, this is a humongous overnight gap down. So the market is in a really tumultuous time right now. It's really tough to trade when most of the action is happening in the overnight session, and in the cash session you barely have anything. So this entire move down happened in the overnight session, right? And then in the cash session, this is all we had. So the big boys are making all the moves at night, and we're just eating off the leftovers. But this is unusual. If this was during regular market hours, the hourly trigger would 100% hold as support here. Also, let's say you were short below the hourly trigger. When do you close your short right here? So number one, you see how this is the most powerful negative hourly velocity to the downside, and then price makes some new lows, but hourly velocity doesn't. That tells you that big buyers are here. And then as soon as the 1 minute trigger crosses the 5 minute trigger, the bot goes flat, as you can see here, and that's when you want to close. So let's say this happened during the cash session and price broke through 99, and now you're short because price broke through the hourly trigger. When do you close your short? As soon as the 1 minute trigger crosses above the 5 minute trigger, which is right where my mouse is right here. As soon as this crosses to the upside, that's where the bot goes short, because most of the time when the 1 minute trigger crosses the 5 minute trigger, you're going to get a move towards the hourly trigger. And that's exactly what you saw right here. Let's see if there's any more. Okay, this is quite similar. Let's check Microsoft. Okay, yeah, these are all similar. So, but did that answer your question?